Good afternoon. My name is Josh here at Chaikin Analytics, and I'd like to welcome you to Tools for Navigating a Volatile Market, presented by Dan Russo, Chief Market Strategist here at Chaikin Analytics. Chaikin Analytics is not registered as a broker-dealer or investment advisor, either with the U.S. Securities and Exchange Commission or with any state regulatory authority. Chaikin Analytics is for educational purposes only and not a trade advisory service. Be sure to submit your questions for the webinar using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. I'll be available to respond to your questions throughout the webinar. This webinar is being recorded, and a replay will be sent to all registrants tomorrow. Dan Russo started his trading career as a specialist and member at the New York Stock Exchange. Prior to joining Chaikin Analytics, Dan was an institutional sales professional where he combined the firm's fundamental analysis research with his own technical analysis to generate trading ideas and investing ideas for hedge funds. Dan is a chartered market technician and is the co-chair of the New York City Chartered Market Technicians Association chapter. To get us started, here's Dan Russo.
All right, Josh, thank you so much for that warm introduction, and thank you everybody for joining us today. If you are in New York, like myself, hopefully you're weathering what can only be called a monsoon and weathering it well. Everybody else, I hope you are dry and warm. What we're going to go through today are tools for navigating a volatile market. And I say volatile market, a lot of people think of volatility and they just think of the moves to the downside. But really volatility works in both directions. And if you have a proven process and the right tools, you can navigate that volatility profitably. And that is what I'm going to walk you through today. I am going to show you my process for finding winners and avoiding losers. And I'm going to show you the tools that I use all within Chaikin Analytics to implement that process to help our clients make money no matter what's happening, up, down, sideways, no matter what's going on from a volatility perspective. We have the tools and the process that can help you navigate that market. So before we kind of dive right in though, just a little bit of background on myself. I've been on the street for 19 years, and if you count summer internships, it's actually a lot longer than that. It's actually 25 years. I was in the fortunate position to start working as a summer intern on the floor of the New York Stock Exchange when I was 16 years old. That was in the summer of 1994. So I'm really coming up on 25 years in the business. And as Josh said, I'm a former New York Stock Exchange market maker. Back then they were called specialists. Now they're called market makers. I'm also a chartered market technician. So basically what that means is I went through a rigorous three-part exam over the course of 2.5 years, self-study, passed all 3 parts to act, and then to earn the right to use the Chartered Market Technicians designation. And I'm also have been asked to be the chairperson of the New York chapter of the Chartered Market Technicians Association. So that was a huge honor for me. Obviously, as you might imagine, the New York chapter is one of the largest, if not the largest, chapters in the world. It puts me in contact with a lot of really smart market people on a daily basis. So being in that position really allows me to leverage the expertise of numerous people in the financial community, which I bring to the table every day for our clients here at Chaikin Analytics. And then I joined Chaikin Analytics in February of 2018. And prior to that, I actually spent 10 years covering large institutional investors, mostly hedge fund managers and mutual fund managers in the New York and Connecticut area. And that really drives a lot of what I do on a daily basis because I have a fundamental understanding of how professional money managers work. 10 years speaking to these people every day or every market day, getting thoughts and ideas on how their investment process works, how they view the markets, the key factors that they look at that they know drive stock prices. That is invaluable and what I bring to my work every day here at Chaikin Analytics. And I'm also a frequent guest on Bloomberg TV. Nice action shot of myself here talking about the S&P 500. I was actually on Bloomberg TV yesterday afternoon, and I will be back on again sometime in mid-February. So I enjoy doing that, and I'm honored that they value my thoughts and insights enough to have me come back every 3 or 4 weeks or so to talk about the markets. So before we get started, I'm just interested, what is your view on the market currently? Are you bullish, bearish, or neutral? And neutral is a position. Josh has posted the poll, and I do encourage you to use the Q&A. Josh is well in tune with my thinking and my process, so if you have any thoughts or questions during the presentation, Josh can answer them. And just waiting now for responses to pour in. Are you a bull, bear, or neutral here on the market?
Dan, I'll just give it a few more seconds, and then we'll share it.
Yeah, that'd be great.
All right, let me share the results with everybody.
So this is interesting. It's really evenly split. 37% of you are bullish, 27% of you are bearish, and 37% of you are neutral. So a dispersion of views, which in my mind really makes sense, because we have gone from an uptrend on autopilot. That's how we like to describe the market in 2017. I know it seems so long ago, but think about what was going on in 2017. Just a nice, steady uptrend. All you had to do was stay invested in the market, and by any dip really of 1.5% to 2%, put more money to work, and you were likely to have a good year. And then all of a sudden, it looked like that was going to continue into 2018. And then we got that big January hit to the market, tried to rally back, and then the retest in February before grinding higher into an ultimate high in September, and then turning lower. And you can really see that here. Here's that initial leg lower, and then the retest, rally to new highs, and now, for all intents and purposes, a bear market move of about 20% from the high. So the question that I get a lot is, will we retest the December lows? And whether you think we will or we won't is not as important, because regardless of what's going on bigger picture for the market, there are always parts of the market that are leading and lagging, and opportunities on both sides of the portfolio. And that's what we're going to go through here today. But one of the things that we did see on the recent low on December 24th, Mark's taken to calling it the Christmas Eve massacre, is we had a huge spike in the amount of new lows in the S&P 500. And what tends to happen when we see these spikes in new lows is that ultimately the low gets tested, but in a less intense way. So what does that mean? Look back here in 2015, the initial low in August saw a spike in new lows. The retest saw a lower low, higher low rather. Same thing happened in early 2016. Initial spike lower, spike in new lows. On the retest, smaller amount of new lows. It happened in the beginning of this year. It hasn't happened yet with the December low. So one of the things that we are looking for, if we do retest those December lows, something that would give us confidence that those lows are holding, would be if the amount of stocks making new lows was smaller than what we saw at those December lows. It remains to be seen, but it's something that I am looking for. What we did see this time around, though, was bullish breadth thrusts, 2 of them actually. Those are generally a positive for the market over the next 6 to 12 months, but they could lead to some choppiness over the ensuing 1 to 2 weeks. And if you notice earlier in in November and December 2018, we did not have those thrusts, but as we went into the very end of 2018 and to start 2019, we actually had 2 of these New York Stock Exchange up volume breadth thrusts where more than 95% of the volume traded on the New York Stock Exchange was to the upside on those days. So that to me tells me that in the near term, we could see some choppiness, but it's bullish over the next 6 to 12 months. So let's kind of put some pullbacks in perspective too. With the thought of that being bullish over the next 6 to 12 months, what we're in now is, call it a correction on the verge of a bear market, a move of a 10% to 20% decline from the all-time highs. We've had about 27 of them over the past 75 years. The average decline is about 13%. We went down about 20%. The average length of the decline is about 4 months. Started at the end of September. We're now at the end of January. And then the average time to recover in months is about 3 months. So this kind of lines up with that view that we could see some choppiness in the near term, but ultimately, if we're looking 6 to 12 months out, signs point to some bullishness, and there's reason to be bullish. Something else that we're looking at that drives that view is the presidential cycle. I do a lot of work around cycles. It's not the ultimate driver of my strategy, but I do pay attention to it as part of the mosaic, as part of the roadmap. And what's interesting is when the S&P 500 makes its midterm year low, the average return 1 year later is 32%. So we made our mid-year low right around Christmas Eve, the day after Christmas. So 1 year later, again, lining up with our view that 6 to 12 months out, there's reasons to be bullish. 32% is the average return 12 months after that mid-year low. And in pre-election years, generally speaking, you get an intra-year pullback of about 11%. This year is a pre-election year. But then again, the average return 1 year after that pullback is 16%. So reasons to be bullish longer term while thinking about that in the context of some choppiness here in the near term. And really what happened in December is that fear gripped the market. This is the CNN Fear and Greed Index. It rolls up a few different indicators and comes out with a composite reading. And it really can be used as a contra indicator at the extremes. And when I mean extremes, today is January 24th. So it was exactly 1 month ago that the market hit that low on Christmas Eve. The CNN Fear Greed Index was extreme fear. It was at a 2. That was a great opportunity to play on the emotions of the market. But you had to have had a process in place to put you in a position to take advantage of that extreme move in sentiment. Now, as the market rallied back, we've moved to a neutral position. So sentiment in the near term becomes less of a tailwind. And really, like I said, when we want to take advantage of sentiment is on the extremes, but you need to be in a position to take advantage of that sentiment at those extremes. And what I'm going to walk through today as part of my process and the tools that I use should better put you in a position so that when the market makes an aggressive move like it does and sentiment becomes as fearful as it does, you will be primed to take advantage of the opportunities there, to do what Warren Buffett tells us to do, to be fearful when others are greedy and greedy when others are fearful. But if you haven't protected your capital on the way down, it's hard to be greedy when the rest of the world is fearful. So just kind of keep that in mind, because at the end of the day, our credo is that fundamentals drive the market, right? We're in earnings season right now. We just started to hear some decent numbers from the banks last week, which is starting to lead the financials to outperform. One of the areas of the market that's been lagging has been semiconductors. Saw some better than feared earnings reports out of bellwether names in that group, like Texas Instruments and Xilinx. So ultimately, it is the fundamentals that drive the market, but it's our human emotions that drive the market to extremes. It's our intense fear that drives that CNN Fear and Greed Index to a reading of 2. I don't think I've ever seen it that low in my 19 years on the street. So the path to profits is to combine the fundamentals with technicals to take your emotions out of the equation. Josh mentioned earlier as part of my bio, I sat on a sales desk. I had a stable of fundamental analysts who were doing research on stocks. They were experts on the industry groups and the stocks that they covered. And I would utilize that and provide my own technical overlay to help my clients, some of the biggest hedge funds and mutual funds in the world, make investment decisions and differentiate myself from others who are on the street. And what's amazing to me is I have the opportunity to do that here now, but without the human bias. And we're going to walk through what that is. But what's really important to keep in mind when we're following a process and taking our emotions out of the equation is that the headlines are not your friend. I tell people all the time, and I was just on Bloomberg, so it's kind of subtle. Turn the TV off, except when I'm on. These are headlines from the wallstreetjournal.com on back-to-back days. I pulled these right from the Wall Street Journal's website on December 3rd and December 4th. Stocks rise as trade tensions ease. Dow tumbles 800 points as trade jitters return. If this is your process for trading, reading the Wall Street Journal and making your investment decisions, think about how you would have felt if you bought stocks on December 3rd and then came in on December 4th and the Dow was down 800 points. That is not a process. That is a good way to get yourself chopped up in the marketplace. Turn off the TV. I'm going to show you the tools that you can use and the process that you can follow to make money regardless of the market environment, to get away from this flood of information that comes at us every day. I was telling somebody the other day, over the weekend, it was Monday, it was 3-day weekend, the market was closed for the Martin Luther King holiday. I think I deleted somewhere around 3,000 emails on Monday afternoon. And a lot of it was, why you should be bullish, why you should be bearish, look at this stock, look at that stock. And it's too much. And really what it does is it feeds on our emotions, but ultimately it does not help us make investment decisions because it's pulling us in too many different directions. So the problem really is, what do you buy and what do you sell and when, in an environment where you're being bombarded with too much information? And the solution are the tools that I'm going to show you here today in Chaikin Analytics. And you can see it on your desktop or on your tablet and coming soon your mobile device. And everything that we do is driven by the Chaikin Power Gauge. It's a reliable tool. It's a simple but powerful tool. I say simple but not simplistic. The Power Gauge looks like a gauge on your car. Rates stocks between very bullish and very bearish, and it can really act as your GPS for the market to help you navigate the market regardless of the environment, regardless of the level of volatility. The Power Gauge helps you know where a stock is headed. It's a clear, tested summary of a stock's potential, and these factors are the 20 factors that make up the model. They're the Mark Chaikin, through his 50 years of experience, much of that time spending time with institutional investors. I covered institutional investors for 10 years. What Mark understood was these are the factors that institutional investors look at because they know that these are the factors that drive forward returns for the equity markets and the individual equities. And when I got the phone call from Mark Chaikin sitting at my desk in early February, I get a phone call. He introduces himself as Mark Chaikin. I said something really silly like the money flow guy. And he said, yes, I'm the Chaikin money flow guy. But then he started talking to me about the Power Gauge and the model and the factors that go into it. And it started to click for me. I was like, those are the same factors that my hedge fund clients are looking at every day. They're trying to get a read on every day, or trying to synthesize down on a daily basis so that they can pick stocks on the long side that are going to outperform and stocks on the short side that are going to underperform. And it just made sense to me because as humans, we're emotional, and the model takes our emotions out of the equation. So we look at 4 key buckets: financials, earnings, technicals, and experts. And again, remember what I said, fundamentals drive the market. The market and this model are 85% fundamental. Now think about that. Mark Chaikin, well-known market technician, created technical indicators, builds a model that's 85% fundamental. I just got done telling you I am a chartered market technician, co-chair of the Chartered Market Technicians Association. I'm deeply involved in technical analysis, and I believe that fundamentals drive the market and that the best way to outperform is to combine the two disciplines, and that's what we do here. The financials bucket looks at all of the things that a value investor or Warren Buffett would look at. Valuation metrics, debt to equity ratios, free cash flow generation. That's where your value investors care. Your growth investors, they care about earnings. Are earnings growing? Is the company surprising to the upside? Is the trend in earnings up or down? And do they consistently meet or beat Wall Street expectations? Technicals are where I come into play and Mark comes into play. We're looking at trend, we're looking at momentum, and we're looking at relative strength versus the market, and that's really important. But for us, and our differentiator is right down here. We're looking at what the experts are doing. We are following what the Wall Street analysts, the stable that I used to have, we're looking at what they're doing because that is the secret sauce to forward returns for the markets. Things like earnings estimate trends, or analysts raising or lowering their estimates. What are the shorts doing? My former hedge fund clients, they tend to be really smart. Short sellers tend to do deep work. It's actually counterintuitive, but highly shorted stocks tend to outperform. I know everybody fears the dreaded short squeeze, but the work and the studies indicate that high short interest stocks tend to underperform the market. So that is something that factors into our model. We look at analyst ratings, insider activity. The experts is really the secret sauce here for our model, and something you're not going to find everywhere else. So the Chaikin Power Gauge, what it does is it cuts through the clutter. All that noise, all that data that you're seeing, if you're looking at income statements and balance sheets, if you're reading the plethora of emails that tell you or try to tell you where the market's going, you have everything you need right here in this Chaikin Power Gauge, rolling up the main 20 factors that move stocks. And most importantly, that research is done for you. On a daily basis, this Power Gauge updates for all the US listed stocks. And when you come in the morning and you log into Chaikin Analytics, the research is there and it's done for you. And the performance in my mind kind of speaks for itself. What we're looking at here is data going back to the beginning of 1999 until the end of 2017. Our very bullish stocks have returned 20% a year on average over that time frame, while our bearish and very bearish stocks have drastically underperformed the market. So think about what this does for you as an investor. If you know that right away when you're making your investment decisions and trying to figure out stocks to buy and stocks to sell, that if you start with our universe of bullish and very bullish stocks, you already have tilted the odds in your favor. The work's been done for you, and you can start from a much narrower universe of stocks that are likely to outperform. We've basically just made you the house. Everybody knows how a casino operates, and I'm not trying to equate this to gambling, but it's a great analogy. The casino makes money because in every game, they have a slight edge. The Power Gauge rating at Chaikin Analytics is your directional edge. And look at how it performs in a down market. Because equally as important as knowing what to buy, it's knowing what to avoid and potentially take advantage of opportunities to the bearish side, especially when the market turns lower. 2015 was a bit of a stealth bear market with an earnings recession. Our very bearish and bearish stocks massively underperformed the market. Russell 3000 was down a little over 1%. Our very bearish stocks were down over 17%. So simply by avoiding those very bearish stocks, you could have avoided the landmines that destroy your portfolio over time. And the reason we use a model, I speak a lot about taking our emotions out of it, but James O'Shaughnessy runs O'Shaughnessy Asset Management, very famous quantitative analyst and quantitative investor, runs everything off of models. If you're on social media, in particular Twitter, I highly suggest following him. He's on there and he shares thoughts and ideas every day. But what he says is that models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by, here's that word again, Emotions. And remember that flood of information? Opinions. So what I'm going to walk through now are the keys to a repeatable stock selection process for volatile markets, but really for all markets. And it starts with a top-down approach that I'm going to walk through. First thing we do is identify the strongest and weakest areas of the market. Then we buy bullish stocks within the strongest parts of the market when they become oversold. We avoid the bearish stocks, or if we want to, buy put options on the bearish stocks in the weakest parts of the market to take advantage of that downside. We use our proprietary signals to enhance performance. And then I'm going to help you learn and understand and know when to play defense so that you are in an opportunity to take advantage of other people's emotions when that CNN fear greed index goes back down to single digits. So my top-down process starts with sector and industry analysis. And again, this is all driven by the Chaikin Power Gauge. What we're looking at here are the major sectors of the market based on their ETFs. And these numbers tell us how many stocks within each ETF have a bullish rating, a neutral rating, or a bearish rating. So when you're looking for long ideas or stocks to buy, you want to focus on the sectors that are leading the market and ideally have more bullish stocks than bearish stocks. So take, for instance, here the financial sector. 21 bullish or very bullish stocks and only 5 bearish or very bearish stocks. We can then look within the financial sector for which areas are the strongest, and that's where the industry analysis comes in. Same process. Well, we want to be looking at insurance. We want to be looking at the major banks. We want to be looking at the regional banks. And we're starting to look at the capital market stocks. So we start at the sector level, identify the strongest sectors. And then within the strongest sectors, we identify the strongest industry groups. And then from there, we take it to the stock level. And the stocks that we want to buy are known as Chaikin Classic Bulls. These are stocks with a bullish or very bullish Chaikin Power Gauge rating that are exhibiting strong relative strength and have strong money flow. And we'll take an example. We'll take a picture of what that looks like. Now, this chart is back from September, but it really does a good job of depicting what I'm talking about when I say a Chaikin Classic Bull. You know, a very bullish stock with a strong trend in a strong industry group. Now, we read our charts from the bottom up, and this ribbon here at the bottom of the screen tells us where the Chaikin Power Gauge rating currently is and where it has been over the past 12 months. So green is that bullish or very bullish rating. Next, we look at how is the stock performing relative to the market, and this is really important. Green, it's intensely outperforming the market. And then we look at Chaikin Money Flow. Chaikin Money Flow tells you what my former clients are doing. Institutional investors try to hide what they're doing. We'll get back to that a little bit later. But bullish stocks that are outperforming the market that are being accumulated by large institutions, those are the types of names that you want to consider owning. And these are the tools that you can use to find those names. And on the flip side, stocks to avoid or even take bearish positions, if you trade put options, are what we call our Chaikin Classic Bears. Power gauge rating is bearish or very bearish. Stock is underperforming the market, and the institutions are selling the stock, and we can see that through the weak Chaikin Money Flow. And a great example of that throughout most of 2018 was Whirlpool, literally a household name. You have their appliances, or at least some of their appliances, in your home, and you can see here just a very bearish stock, underperforming the market, being sold by institutional investors, and that created just a nice steady trend lower with plenty of opportunities to sell the stock or open positions to the bearish side of the coin. And what really is, if we're thinking about our tools, the two main tools are the dynamic duo, or what we like to call the dynamic duo. It's the Chaikin Power Gauge rating, gives you your directional edge, and Chaikin relative strength points you to the stocks that are outperforming the market. The dynamic duo finds big winners and losers because we know that superior returns come from stocks that outperform the market. And I really want you to let this sink in and synthesize. Relative strength stands alone as a bullish or bearish indicator. And the reason that is because the large institutional investors, the mutual funds, think about Fidelity and Wellington and T. Rowe Price and a lot of the big names that you've heard of, their managers are measured on relative performance. It's not enough for them to own a stock that goes up 10%. If they own a stock that goes up 10% and the market's up 20%, they've underperformed. At the same time, if they own a stock that goes down 5% while the market's down 10%, they've outperformed. That is why relative strength is so important, because the big money managers that drive the market, that's how they're measured. And something I want you to think about and take away from this presentation today as you're thinking about your investments going forward. We're going through a volatile, choppy time for the market. When you're looking for ideas, the stocks that held up the best are likely to lead when we ultimately come out and go back into an uptrend. And the way that you can identify the stocks that have held up the best is to look at relative strength. Now, once you've figured out the types of stocks you want to own, your classic bulls, and the stocks you want to avoid or take bearish positions, your classic bears, we give you our proprietary buy and sell signals, 6 sets of signals that help you get what many investors think is the most difficult part, timing. Helps you get the timing right? Because we can show you bullish stocks that are outperforming the market, but if you don't buy them at the right time, that's going to have an impact on your performance. So we give you these sell signals, and then we alert you when those signals are triggered. You can see them on the dashboard within Chaikin Analytics. If you're keeping a watch list every day, when you log in, you'll be able to see your stocks that triggered buy and sell signals on the day. And to take the done-for-you research aspect of things one step further, we'll also send you a daily email alert. So maybe you're on the go, maybe you're on your way to work, you can't log into Chaikin Analytics. You see an email that tells you which stocks that you're watching have triggered buy and sell signals on the day. And I'm just going to show you an example here with HollyFrontier, an oil refining company. It was a widely owned name for a while, but on November 9th, it triggered a relative strength sell signal. Now, the stock had a good run, started to go sideways, and then relative strength began to waver, and money flow was bearish. So institutional investors were selling the stock. So if you own this stock and were looking for an opportunity to sell it, that email on November 9th was your catalyst. You could have sold the stock at around $67.50 on its way to 45 and sidestepped a landmine that could have been detrimental to your portfolio and put yourself in a position to take advantage at the market bottom down here when that CNN Fear Greed Index was at 2. So that's my top-down process. We start with the power gauge. We look at industry and sector relative strength. We combine Chaikin money flow and Chaikin relative strength with our proprietary buy and sell signals to tell us not only what to buy and what to sell, but when to buy and when to sell. So let's kind of walk through. I just want to walk through a few of my examples, in real life. One of our key themes for 2018 was bullishness on the retail space. And this is the XRT. It's the ETF that closely tracks the retailers. And you can see here, nice, steady uptrend throughout the majority of 2018 with plenty of opportunities to open positions in bullish names to the long side. You can see here the institutional investors were accumulating these names, and retail was outperforming the market. And at that time, our Chaikin Power Gauge ETF rating was on a bullish rating. But look at what happened in October. Funds started to roll over. Institutions were selling, and it began to underperform the market. So during this phase, while retail is outperforming, we want to look for bullish ideas, and that gave us opportunities to identify a name like Macy's at $28. Power gauge rating turned bullish. Stock was outperforming the market, so that dynamic duo was in gear. Institutions were buying the stock And our proprietary overbought, oversold indicator was on an oversold reading when one of our signals triggered. This one, a relative strength buy signal. We identified this stock for our clients at $28 on its way to 40. But when the environment changed, we wanted to look for opportunities to the bearish side. And the Gap, a name you all know, GPS, Gap stores, throughout the retail weakness has been the gift that keeps on giving. Bearish stock underperforming the market, predominantly bearish money flow, clear downtrend, and all along the way we've been getting signals to tell us when to trade or sell the stock or open a bearish position. These are our overbought sell signals, and they've been reliable through this entire downtrend here to tell you when to sell the stock. Power gauge and relative strength tell you what to sell. Gap signals, all part of the done for you research, tell you when to sell. Because at the end of the day, I'm going to bring Uncle Warren back. What we are looking for is what we call the ideal setup. Warren is favored for saying they don't call balls and strikes on Wall Street, so you don't have to swing at everything. You can wait for your pitch. You know, I have some buddies who work up at Fidelity. They call it the Fidelity fat pitch. You can call it whatever you want. Ideal setup, the fat pitch. The point is, you don't have to swing at everything. You can wait for the right opportunities that fit your process. So software has been an interesting theme over the past 12 months because it's gone from bullish to bearish and back to bullish again. Now you can see here, steady uptrend for the XSW, the software ETF, until October when it begins to underperform the market. And now it's actually beginning to outperform again. So within those different environments, we take advantage of the opportunities by using our process. When software is outperforming, as it was through the majority of 2018, look at Adobe, a nice steady uptrend, a bullish stock outperforming the market, being accumulated by institutional investors, type of name we want to own. Buy signals all along the way telling us when we want to own it. In this case, we're buying pullbacks within an uptrend until the trend line breaks, the stock begins to underperform, and institutions are selling, giving you a good indication, the tools you need to tell you not only when to get in, but when to get out, done for you. As software begins to underperform, we look for opportunities to the bearish side, or we look for names to sell from the portfolio. Square, part of the super hot fintech space now. You've probably seen their products if you've ever bought anything and had the cashier swipe your card on an iPad. They're probably using a Square product. Great story, great idea. Process told us to avoid it. Why? Chaikin Power Gauge rating turns bearish in October. In November, stock begins to underperform the market. So we have software underperforming, and now we have a weak stock underperforming the market. Type of name we want to avoid or sell. We get one of our proprietary sell signals here at $80. Stock goes to $50 shortly thereafter. Following the process, once again, software has begun to outperform. One of the names that we like a lot, Mark Chaikin has spoken about it. I've spoken about it. Salesforce.com. This chart is as of this morning. Look at the setup here. Bullish stock, outperforming the market, being accumulated by institutional investors, has broken through these interim highs and is now building a base around the $150 level. Remember what I said earlier. Stocks that have held up the best on a relative basis are likely to be your leaders when the market bottoms. Look at this relative performance. The tools you need to get you into and out of the right stocks at the right time. It's why Ken H was able to turn a $235,000 account into $1.2 million in 7 months. Never would have been able to achieve this without your system. So I'm often asked, Dan, do you look at the charts of 5,000 stocks every day to try to figure out which are likely to lead, which are likely to lag? And the answer to that question is no. I mean, I would never have that time. I'd still be doing it. I wouldn't be speaking to you here now. what we give you is a screening tool so that you can identify the types of names to own. This is a screen that I actually run constantly. You can see here, it's called the relative strength screen because relative strength is that important. This is one of my go-to screens when looking for ideas for names that are likely to lead as the market stabilizes and when it eventually begins to trend higher again. And really in 4 clicks of the mouse, I can take 3,000 stocks down to 176 stocks that meet my criteria. And just given the fact that, I want names that are more liquid, if I filter down one last time to only large caps, I come out with 45 names that are likely to outperform the market going forward. And if you want to screenshot this, take a picture of it, whatever it is. I ran this screen this morning. This is a live screen. These are names to consider now. Here's Salesforce.com. A lot of names on here that you've probably heard of. Bank of New York Mellon, Molson Coors, Starbucks. All high-quality names with bullish Chaikin Power Gauge ratings that are outperforming the market with strong money flow. The tools you need to find the stocks you want to own. One of the names that was on that list, VMware. Again, this is what I'm talking about. Software and services. We talked about software beginning to lead again. Look at VMware. VMware is a very bullish stock, outperforming the market that's being accumulated by institutional investors. And even as the market started to crash in the September-October timeframe, VMware is trading at a 52-week high. Type of name you want to own. These tools helped you identify that. But anybody can kind of tell you what to own. In a volatile market environment, the key to making and keeping money is to minimize your exposure to danger and risk. Part of that is knowing when to sell a stock that you already own because it's on the verge of heading lower. And part of that is knowing when to not go bottom fishing in names that are likely to continue to head lower. And what I'm going to share with you now is a secret sell signal that 95% of traders don't see. I mean, wouldn't it be great if you had a signal and the tools to get you out of a winner and keep you out of a loser? We've identified that for you. It's called the Chaikin Bearish Money Flow Sell Alert, and I'm going to walk you through it now with probably the most famous name of them all. We all recognize this stock. It's Apple. It's one of the most widely owned stocks in the world. And for good reason. It had been a massive outperformer up until October of this year. However, as the stock started to roll over, it witnessed what we call a bearish personality change. It went from a leading stock to an underperformer. And look at what was happening as the stock was making new highs. Institutional investors were using this strength to the $230 level to sell the stock. The smart money was getting out of the stock. Stock went sideways for a bit and began to roll over. Institutions continued to sell the stock. Now, I'm not saying we were smart enough to get out at the absolute high of $230, but had you been following our process and using our tools, you could have gotten out of Apple at $210 on its way to sub 140. The tools were there. The signals were there. As the stock was making its high, the institutions were selling. Another name, widely known, also for good reason, NVIDIA. As NVIDIA was making a new high in October, the same story was playing out. Institutions were selling. At $260, Chaikin Power Gauge rating turned bearish. Stock actually began to underperform the market. And that's right around when Goldman Sachs came out and upgraded the stock to a conviction buy when the stock was trading right here around $240. We were already bearish on it. The stock was already underperforming the market. Goldman had to come out with a mea culpa down here after this earnings miss. They loved it at 240. They had to give their mea culpa down here around 140. Tools were there to take you out of the name. Or what about bottom fishing? Mark Chaikin has called bottom fishing one of the most expensive sports in America, and here's why. Philip Morris was in a steady downtrend when it rallied from around $90 back to $100. We actually used that as an opportunity to identify it as a bearish candidate for our clients because it was a bearish stock underperforming the market, being sold by the institutions. It triggered one of our sell signals. I made it my bearish stock of the day in Chaikin Analytics on a Monday. They reported earnings on Thursday. Stock promptly dropped over 20% and continued to trade lower. Halliburton, another name well known. Our tools could have gotten you out of this stock before oil completely collapsed as it's done recently. Very bearish stock, underperforming the market, being sold by the institutions, triggers a sell signal. All along the way, opportunities to get out of a bearish stock that was underperforming. Power gauge was bearish, relative strength was weak, and the institutions were selling the stock, and our proprietary signals were triggering all along the way. Great opportunities to get you out or keep you out of a name like Halliburton. So now, I want to talk about what happened in October and how we changed our positioning and helped our clients be in a position to take advantage of that extreme level of fear. One of my favorite quotes on life, but in particular on the markets, comes to us from John Maynard Keynes. He's credited with saying, I say credited because it could be in dispute, he's credited saying that when the facts change, I change my mind. And in October, the market facts that we were looking at changed. So we became more defensive. And for us, what we were looking at was this breakout to new all-time highs that did not continue. And when the market broke lower from there, this told us that something was wrong. The fact that the market couldn't sustain a breakout told us that something was wrong. And that was backed up by the fact that institutional investors were selling stocks. As the S&P 500 was making new all-time highs, the institutions were selling. When we broke through this key level, I started writing about in my note to Chaikin Analytics clients, which you'll receive on a daily basis when you become a Chaikin Analytics member. I advise switching to a defensive posture, looking for bearish opportunities and favoring the groups that do well in a bearish environment while keeping stock selection and stock picking and the tools that we use in place to identify the best opportunities. So one of the areas that we said to avoid was the leisure and entertainment group. Here is the ETF that tracks that group. PEJ is the Invesco Dynamic Leisure and Entertainment ETF, and you can really just see it here. Actually began to underperform the market before the market top, but continued to do so throughout the back half of 2018, all while institutional investors were dumping these names. Well, we identified Wynn as a potential loser. Wynn began to underperform the market in June and had a very bearish rating in late August, early September, with institutions selling the stock. The stock became overbought and triggered one of our sell signals, at which point I told our clients to consider playing the downside through a bearish vertical put spread. We closed that trade for 158% return on the options trade over the course of about 6 weeks. Wynn was a weak stock in a weak industry group. We took advantage of our sell signal to tell us when to put the trade on. Domino's Pizza. We made the call that Domino's was not going to deliver, which was amazing because at the time, Domino's was actually being touted all over TV as a tech company. They were implementing technology to better run their business. Well, our process and our model told us that none of that mattered because in October, the stock was very bearish, underperforming the market with bearish money flow. We identified a bearish put spread 3 days before they reported earnings, which disappointed the street. We closed that put spread for a 100% profit. Healthcare equipment. Healthcare equipment was one of my go-to sectors in the first half of 2018. But when the facts changed, I changed my mind. The group started to roll over and began to underperform as institutions were selling. Instead of looking for bullish ideas, as I was all throughout this period of the uptrend and outperformance, I started looking for bearish ideas. One of the names that I came across was QDEL, QDEL. QDEL was underperforming the market starting in September, but when that rating turned bearish, when the dynamic duo got in gear, when the market and model were in agreement, we identified it as a bearish opportunity. We opened an options trade, or suggested our clients open a bearish options trade on November 21st. A couple weeks later, they received an unfavorable court ruling, took the stock lower. We closed the trade on December 13th for 117% profit. Process over and over again. No emotions, just following the process. But part of being defensive means there will be opportunities to actually make money on the long side. Utilities were a safe haven as the market was going lower, and we identified American Electric Power back here in the October timeframe. So as the market was heading lower, AEP was a solid outperformer. What we had at the time was a bullish stock outperforming the market being accumulated. Triggered one of our proprietary buy signals. We suggested it as a long idea around $70 on its way to 80. Think about what was happening in the market in this time frame. The market was topping and heading lower into that December 24th capitulation low. Had you owned a name like AEP, you could have taken profits and been in a position to capitalize on that extreme level of fear. But stock selection is really important because not all of the utilities were set up favorably. Here's one we actually identified as a bearish idea. So in a group that investors were flocking to for safety, we found a bearish idea that helped our clients make money as the market was heading lower. El Paso Electric was a bearish stock underperforming the market, being sold by the institutions. It triggered a sell signal, and a couple weeks later, we said you should enter to the bearish side. Our bearish options trade, we ended up closing it at about a 60% profit for our clients. And those are the types of trades that put you in a position to capitalize on other people's fear and other people's greed. So Chaikin Analytics is an award-winning platform. We're proud of the fact that we were selected as the 2017 Benzinga Global FinTech Award for the best trading idea platform. And something that really helped us get that award and put us in a good position was what we like to refer to as the Netflix for stock ideas. This is our stock discovery engine. And as you're doing your work and looking for strong stocks in leading industry groups, you may start to think, well, what other names share these characteristics that I should consider on the long side? And what names should I avoid? So we talked about CRM. We talked about how much I liked Salesforce.com. When I load CRM into our discovery engine to find other names that look like it, look what kicked out. We looked at VMware. Cadence, CDNS, software company, actually Mark Chaikin featured it as his bullish stock of the week in his note to Chaikin Analytics clients this past weekend. Let's take a look at Cadence. Cadence is a bullish stock which is intensely outperforming the market while institutional investors are starting to buy it. You can see here we've broken a near-term downtrend line and we are starting to work our way higher. This is this type of stock you want to consider on the long side because of that relative strength, because it's been outperforming and institutional investors are now coming to it. And the market and model are in agreement. Type of name you want to consider. I ran this chart today. It's something you want to keep an eye on here going forward. Add it to a bullish watch list. Keep an eye on it. So that is Chaikin Analytics. It is a proven stock selection system where you will get daily email alerts to tell you when is the best time to buy and sell the names that you are watching. Chaikin Analytics, an annual subscription is $21.95. You can head over to chaikinanalytics.com/tools to sign up to become a member, where you will receive our screener that I showed you to identify those names. We also have our options play tool that can help you structure the options trades, the ones that have the highest likelihood of paying out, so that you can take advantage of those signals, especially when they trigger to the downside. In addition, we're going to give you daily charts so you can see the best time throughout the day to put your position on. We're going to give you earnings details. We'll tell you when the company is due to report earnings, what the estimates are, what they reported last year, what the street is looking for, all the fundamental data points that drive the market. And as I mentioned, every week, Mark Chaikin writes his weekly market insights. Comes out middle of the afternoon on Sunday. It's a great read, gives you everything you need to know to get you set up for the week. Plus, when you become a subscriber, you'll have members-only access to our weekly strategy webinar, which I host along with Josh, who's on this call. You'll have unlimited coaching and support, including small group sessions and one-on-one coaching from our client success team. And every day that the market is open, you will receive my daily morning insights, where I identify names like Salesforce to the upside and Win to the downside. So as I said, Chaikin Analytics, $21.95. But as a webinar special, we are going to knock $400 off the price of the subscription. Everything that I showed you here today for an annual subscription of $17.95. Head over to chaikinanalytics.com/tools or call the number on your screen, where our team is standing by to help. I want to thank everybody for taking the time to be here with me today. Have a great night.
Thank you, Dan, and thank you, everybody, for attending today. You can go to www.chaikinanalytics.com/tools or call us 877-697-6783. Our colleagues are available to answer any questions you have and get you started with Chaikin Analytics. Again, that's www.chaikinanalytics.com/tools or give us a call, 877-697-6783.